Welcome to Zombie Advisor with James Knapp, the only podcast where being undead isn't an excuse for being unresponsive. This is the space where financial advisors and clients come together to break free from the old, slow-moving reactionary system. Tune in as we shake the dust off of outdated practices, dissect what really matters to today's clients, and tap into the brains of industry leaders who are actually alive, alert, and crushing it.
Welcome to Zombie Advisor. Today is May 26, 2026. The weather in St. Paul, Minnesota is 89 degrees. On this day in history, the S&P 500 bottomed out, concluding a devastating 18-month bear market triggered by the 1969 to 1970 recession, whereby it fell over 36% during that period of time. Famous day. Today's guest is very special. He's a legend in the world of tax and estate planning. Greg Carlson has a Bachelor of Accounting from the University of Minnesota, Master's of Business Taxation from the University of Minnesota, graduate certificates in estate planning from Villanova, Master's of Legal Studies from ASU. Greg has many accreditations, the CDFA, RICP, CM, and AA. CPA and PFS. I refer to Greg as our resident expert. Welcome to the podcast, Greg.
Thank you.
Yes. Well, how did you decide to go into accounting, and why do you have so many designations? But first, let's talk about how you got to be an accountant.
Totally by accident.
Really?
I started as a chemical engineering major.
Wow.
Went through about 2/3 of a year taking 8 a.m. accelerated chemistry classes while working nights, and decided I wanted something a little bit different. And I was also interested in the business school. I have a couple of older brothers that went into business degrees.
Okay.
And I saw that 1:00 in the afternoon accounting class. That was very appealing. So it all started because I wanted to be able to get a little more sleep in the morning.
All right. So you're at the University of Minnesota, you're in chemical engineering, you pivot to accountancy. Was your family always in business, or just your brothers?
Just my brothers.
Okay.
But there's a lot of similarity between engineering and accounting. A lot of people in the business school started out in engineering. I don't know if it goes the other direction, but logic-driven, scientific logic, it all kind of fits together.
Yeah, it makes sense. Rules-based principles. One step goes to the next step, and it all has to tie out, right? And that's basically chemical engineering in its whole. Like, we saw that on this day yesterday, there was a chemical fire blowing up in LA, which was pretty amazing to see that, right? All right, so you decided to become an accountant by accident. Then what? Take me through your steps.
Well, I started as an auditor with one of the then it was the Big Eight.
Sure.
But it was really kind of boring auditing. Auditors are supposed to be rules followers.
Sure.
Their creativity is not something that they appreciate. Whereas with taxes, you're the client's advocate, which you're not allowed to do as an auditor. You're rewarded for creativity, finding the way to make a structure work, finding a way to make a problem go away.
Sure. What's the problem? Taxes, structure,
taxes. It could be family issues. I probably should get a degree in psychology, because the family dynamics is probably more of an issue than the government agents.
Yeah, blood or money, one or the other, right? One or the other. At Luther, we have this class called Paideia. You have to take it as a humanities class as a freshman. Paideia is continuous learning throughout your life. It's a Greek term. I see that you've taken that very seriously.
Yes.
You're either working or in school is all I can figure out.
or a few concerts here and there.
Yes, you are an avid concert goer. So you just got back from New York, and you said you saw three Broadway plays?
Three Broadway plays.
Yeah, and you see about 100 shows a year, is my understanding.
Depends on your definition of a show.
Okay.
My plan this year is to see about 150 bands.
Whoa.
That counts the openers.
Sure. Okay. So you might see 3 in one night, right? Or 2.
Usually 2.
Usually 2 when you get there. Okay. So that's a lot of shows. We're here to talk about zombie advisors. So as you're educated and we come to think about some of the cases that we worked on together, one particular case came to mind for me. It was a client that was referred to us. They had a C Corp. And in that C Corp, there was some tax analysis that you did to convert them to an S Corp. Walk me through that. Why were they a C Corp? Why would they be better off as an S Corp?
So that you're looking at 2 different time frames. There's the actual operation of the business, and there's that eventual exit from the business.
Right.
And for most taxpayers, that exit is going to be a lot less expensive if they are some form of a pass-through entity,
Sure.
Be it an S Corp or a partnership. Mm-hmm. And so the goal is to minimize the taxes during the operating period, which you can usually do, mm-hmm. and to have it set up in a structure that's going to be not only beneficial for the seller of a business, but also for the buyer of the business, because the buyer is going to pay a lot more if they can get some kind of a tax benefit. Mm-hmm. The buyer is always looking for an asset purchase because mm-hmm. it's going to result in more tax benefits to them. Yep. And so by logic, they should be willing to pay more if they can buy assets. Mm-hmm. But from a seller's perspective, they would prefer to have a stock sale or an entity sale because they generally pay less in taxes if it is a stock sale. Mm-hmm. So what you're trying to get to with a pass-through entity, S corporation partnership, is something where the buyer is getting the asset purchase that they want, right. And you structure it in such a way that the seller is getting maybe not a perfect structure, but almost perfect structure, and the combination of the two is going to be better for both sides.
Right.
Ultimately, you want to have more after-tax dollars for the buyer, and everything else. It doesn't matter whether it's in the form of less in taxes or more in proceeds. Bottom line is you just want more to the buyer after the government takes their share.
Right. So what comes first, the chicken or the egg? The government comes first, and then what's left over?
Well, you try to structure it so that you maximize both of those. You never want to let the taxes control the transaction. Mm-hmm. You come up with the what the buyer and the seller have to have. There's always some non-tax considerations that come into play.
Sure.
Once you have that in place, then you figure out, okay, now that I know what the parameters are for the sale, now how am I going to structure that in such a way that it's the most tax efficient?
Sure. Like my mentor would always say, don't let, there's 10 things to think about in any transaction. Only one of those is taxes.
Right.
The other way to say it is you can take terms, I'll take price, but both of us are going to be negotiating on each side of the coin for that.
Right.
Okay. Well, this one was kind of interesting because this particular client had stock. They had owned mutual funds inside of their C Corp because they had retained earnings and they wanted to make some money on it. So they bought NVIDIA and some other stocks inside of there. And then when we converted it to an S Corp, we decided that they had to hold those stocks for a period of years, right?
Right. So with a conversion, if you have always been an S corporation, it's very straightforward.
Yep.
If you were previously a C corporation, then there is a 5-year period of time where the the government says we don't want you to avoid C Corp level tax just by switching to S Corporation.
Right.
So they had this 5-year look back. And if at the time that you made your election to become an S Corporation, if you had any kind of appreciated assets, it could be equipment, buildings, investments in this case.
A car, art.
Right. Sure. That they will hit you with a C Corp level tax,
right.
Even though you're an S Corporation.
So the government's got their hand in your pocket for 5 years.
Right. And so in this particular case, the client was charitably inclined.
Right. They were.
And wanted to give stock or cash, any kind of an asset to charity. Sure. Yep. And what we discovered is that if you give stock investments directly out of an S corporation, it's not treated as a sale or exchange, so it's not subject to this 5-year look back built-in gains C Corp tax.
Right.
And as a pass-through, the deduction to the charity still comes through just as if the individual had given it themselves. And so the key is that the corporation is making the charitable deduction, right, passing it out to the individual.
Right.
You'd get a totally different tax result if the individual distributed the stock, mm-hmm, and then made the same donation to the charity.
But the church didn't care because they still got the same amount of money, right?
Right.
And they don't pay the tax.
Right.
Right. So we're benefiting a church, but we're doing it in a very thoughtful way.
Right. And you're not only getting, you're avoiding the built-in gains tax, but you're also getting all of the benefits that you would normally get from donating appreciated stock. You're avoiding the capital gains tax, yep, and you're getting a deduction equal to the fair market value of the stock.
Right. So it's the best of all worlds.
Right.
Yeah.
Hold up. Just a quick pause in the zombie action. You're listening to Zombie Advisor, and I'm so pumped you're here. Got a question? Want to challenge something I said? Head over to boyumwa.com or hit the show notes to find me. Don't be shy. I'm not actually undead.
See, you said at the beginning that you get creative and you like to be creative, whereas auditing is not so much that way. Taxes is more creative than people think, right?
Right. I mean, every time that I see, sometimes we get called in at the very beginning. Sometimes it's very close to closing time. Mm-hmm. But any time that I see a transaction, usually the attorneys are very good at making sure that they've covered all of the legal issues. Mm-hmm. They aren't necessarily, a few are, but most are not very comfortable with the taxes. No. And almost always I can find something in a transaction, either I can switch an entity from a C corporation to an S corporation to, mm-hmm, avoid net investment income tax. Right. I can keep an entity sale rather than an asset sale. Still give the buyer the asset purchase treatment that they want, right, but still get the deductions that I want at the seller level by setting up a holding company. Right. All kinds of things like that. There's always something that you can do. It's rare that I can't look at a transaction structure and find something that can be, tweaked here and there,
benefiting the buyer or seller, depending on which side you're on.
Right. We had a transaction that actually closed a little bit earlier this year, and it was already a done deal. The documents are already laid out, and the only change that we made was it was going to be a sale of an LLC partnership, okay, and they were selling the LLC directly to the buyer, okay, which would be an asset purchase, yep, from the point of view of the buyer. The problem is that it was the individuals selling the LLC units, and that did not allow what most states have something called a pass-through entity tax, right, which is basically a workaround for deducting all of your state and local income taxes.
Salt tax.
And the benefit that we were able to come up with was to simply drop the LLC units into a new LLC holding company.
Yep.
And then the LLC holding company sold the LLC units.
Yeah.
And the buyer didn't care. They were buying the same entity. We had to tweak a few documents here and there.
Yeah.
But in the end, it resulted in about $250,000 in federal income tax savings.
That's a lot.
So well worth, $5,000-$10,000 worth of accounting and legal fees to make some changes. So,
Totally.
So there's always something like that, even if it seems like you've got your deal structured and everybody's happy with it. You can usually find something there that's beneficial.
Yeah, think about it this way. So if let's go back to the case that we worked on. So now this guy's an S corp. Now he's selling it to his kids, right, from an estate planning standpoint. So we're going to go one step further. He's selling it at a non-marketable security discount to his kids. Those kids are going to pay off that note over time, and he's going to retire. And that's kind of the way this is going to go on. He's going to have enough money to be financially independent. The business is going to be run by one of his sons. The other kids are going to be working around that. And he's basically he's moved his business onto the next generation in a tax efficient way. Had he been a C corp, there was some retained earnings and there was a big tax bill that was a part of that, if I remember correctly.
Right, and any time that you've got a C corporation, you're always looking at the potential double tax.
Right,
and here, if you're combining estate tax and income tax, and most of our clients are not really that concerned anymore about federal estate tax because they've got, in most cases it's a $30 million exemption.
Yep.
But for Minnesota, it's only $3 million per person.
Right, very low.
So we're always trying to structure it so that we not only get the income tax benefit, but you do it in such a way that you can minimize the estate tax.
Right.
And it's a combination of things. But I always the starting point is with estate planning is what's this going to look like after the plan is completed? Are you going to have the family members in the position that they wanted to be in?
Mm-hmm.
Is this going to be a business that can operate efficiently in this kind of a structure?
Mm-hmm.
And then you kind of work back from there to say, okay, now how do we get the best possible income tax and estate tax result given those criteria? Again, you don't start with income or estate tax. You start with the business,
mm-hmm.
and then from there, okay, what does the family need to have, or the business owner, what do they want to see happen?
Mm-hmm.
And then after that, you try to figure out, okay, what's the best tax result? And sometimes paying more in estate tax is better because it results in income tax savings. Sometimes paying more in income tax is better because it results in less estate tax. It's especially true in a situation where you have Minnesota residents
mm-hmm.
that are potentially subject to only a Minnesota estate tax.
Right.
And so having the benefit of a federal and state income tax basis step up, which you get when assets pass through an estate.
Right.
Working on something right now where it's probably going to be beneficial
mm-hmm.
to pay some Minnesota estate tax because the benefit of that income tax step up is actually worth significantly more than the estate tax that they're going to pay.
Yeah, so it's another calculation. I mean, we always start with the beginning. So begin with the end in mind and understand what your client's goals are. And you then take the information and come up with, it's a puzzle. Every puzzle is a little different, and all puzzles have different pieces to them. But you have a set of rules, and those rules don't change very often, maybe every year, maybe every other year, maybe every 4 years, maybe every 6 years, maybe every 8 years. It depends on how often these rules are going to get touched.
Maybe last week, which it literally did.
Yeah, which changed again. Yes. So we have the set of inputs from our clients. We know what the game is. So the game is by the set of rules that we have. And then it's a jigsaw puzzle or Rubik's Cube or whatever analogy you want to put those pieces together so that our clients can make the best and most informed decision for themselves.
Right.
Right.
And ultimately it is their decision. I've had clients that have said, my kids are getting more than enough. I'm not going to change certain things in my life. I'm not going to change where I live. I'm not going to do, I don't want to complicate my life.
Yeah.
And that's fine. They don't care that they're going to pay some taxes because the simplicity of it is worth far more than whatever taxes they're going to owe. And you have to respect that. That's their choice.
Absolutely. My parents moved from Hudson to Cedar Falls last year, and that's 6 miles away because their entire community is their entire life for 72 years in this community. And they were not willing to move to Minnesota to do that. And I applauded them for doing that. Some people just like their community a lot. Some people like their neighbors more than, their property taxes. I mean, there's a million reasons why we stay here.
And we have a lot of clients that are snowbirds that they retire, they go to Florida or Arizona, and then, maybe 15, 20 years later, they start returning to Minnesota because they want to be close to family and healthcare.
Yep.
They want the son or daughter to be able to check in on them, to take them to their doctor's appointments.
Right.
All of those things become a lot more important than saving income tax or estate tax.
Yep. But we just give them the decision-making tools so they can make an informed decision.
Right.
Yeah. They're the CEO. We're just outsourced CFOs, right? So it's kind of fun. We didn't even really get into estate tax. We didn't really get into estate planning today. We're going to have to cover that in another time because this has been very riveting from my perspective. So I hope that you come back again.
Absolutely.
All right. Awesome. On that, thanks again to Greg Carlson, the great Greg Carlson, for joining us today and sharing your insights. Thank you for taking the time to listen. We truly appreciate it. If you enjoyed this episode, be sure to follow us on YouTube and subscribe anywhere you listen to podcasts so you never miss a future conversation. We'll see you next time. Go Boyum.
Thanks for listening to The Zombie Advisor with James Knapp. Don't forget to hit that follow button so you never miss an episode. Want to learn more? Visit us at boyumwa.com, BOYUMWA.com, or give us a call at 651-289-6444. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Boyum Wealth Architects. The content has been made available for informational and educational purposes only and is not intended as a substitute for professional investing advice. Always consult your financial advisor or other qualified service providers with any questions you may have regarding your personal investment planning.